stocks are like a company. You can own a slice of a company. So if you believe like Apple is going to gain a lot of money, if they're going to be innovative and grow, then you buy a stock because it's a slice of that company. It's all about the company growing.
Stocks are a way to buy into a public company, and you can buy like a share and use your money, and it's a way to invest and then hopefully make a return.
Well, I believe stocks are basically shares that a person can buy of a corporation or something. So you can buy, depending on what the company is, you can invest and buy maybe 2 shares of Apple or Microsoft or something.
It's expensive though.
No, not necessarily.
Yes, it is. Apple is expensive right now.
Apple is, but
Yeah, we're talking about Apple. And Google. It's
Google's
expensive,
cheaper.
but it's still expensive.
Let's take a step back. Stocks, sometimes called equities, are a form of ownership in a company. If you own stock in a company, that means you own a small piece of that company's assets, profits, and future growth. In the next few minutes, we're going to explain what an initial public offering, or IPO, is, how stocks are traded, how risky it is to own stocks, and why you might buy or sell stocks. Let's start with an example. Companies that are growing quickly sometimes need more money to make new products or set up more stores. Take a company that makes burritos. They have 10 stores, but keep selling out. They know if they set up stores nationally, they could sell a whole lot more. They just need the money to expand. One way to do this would be to sell equity or stock in their company and go public. But how does this actually work, and what does it mean? It's called an initial public offering, or an IPO. Take the burrito company. When the company just started out, it was funded by private sources, an uncle, or even a loan from the bank. But when it grew, it wanted to raise more money than it could get from private investors alone. So, the company decided to raise money through an IPO. To do this, they created a ticker symbol, hired advisors, and listed their company on a stock exchange. After their IPO, anyone could purchase their stock, and like every public company, they would be regulated by the Securities and Exchange Commission, known as the SEC. Let's say that when the burrito company has its IPO, it raised $50 million by selling 1 million shares of stock for $50 a share. The company can now use this money to buy more equipment, set up new stores, hire more employees, buy more ingredients to sell more burritos, and make more money, which should hopefully make their shares go up in value. Now, how risky is it to own shares of a company? The short answer is pretty risky. In buying shares, you were buying a small piece of ownership in the company. You were considered a shareholder. As a shareholder in the company, you benefit as the company grows, but suffer if the company fails, which could result in the full loss of the money you invested. Knowing how much risk you are willing to take on, or your risk tolerance, takes time to figure out. Now, how are stocks actually traded? Stocks are traded on exchanges, such as the New York Stock Exchange or the NASDAQ. Exchanges are like supermarkets for different companies' stocks. It's one place where everyone can find stocks and buy or sell them. As a side note, the index with the largest 500 companies is known as the S&P 500. How do you decide when to buy or sell stocks? Well, people trade depending on many factors. For example, how the company has performed over past economic cycles, whether the company's industry is growing or declining, or if there's a high risk of competition, whether the company has a good management team or brand name, if the company's stock is currently cheap or expensive, if the company pays a dividend, and many more variables. Let's take a quiz to recap.